Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about, let's say, 20 minutes today. Let's go short and sweet today. It's hard to get bullish in the market. September and October are upon us. We already seen some volatility. It's just amazing how it picks up almost to the day. I still recall last year doing an open wing butterfly in the VIX that paid the very first day that we put it on. And it actually was a max gain. It was probably one of my better trades that I put on last year. And that was right on September 1st. And we did it again on October 1st. And we had more volatility in September than October. And once again, the markets don't necessarily go down. And on a percentage basis, if you go back throughout the years, really September and October are a smidge down. But the bottom line is that they usually go down. Oddly enough, compared to most of the other months in the calendar, September and October have a tendency to finish the month down. Now, there's never ever been any papers that I've ever seen written on it that explain it well enough. You know, there's always mutterings about mutual funds having to shore up their portfolios, yada, yada, yada. But that's more about the Santa Claus rally in my mind, which is the period between Christmas and New Year's. So I don't understand it, but I'm going to lean bearish. I don't have a stock that I want to get bullish on. Earnings season is almost over. The one earnings report that is yet to come this week that I would find interesting is Dollar Tree's going to announce, I think, before the open on Wednesday. I don't necessarily want to do a trade on it, but once again, it's more about the consumer. With the PCE coming in, inflation comments afterwards, after the earnings report are big, considering the news that we've had. It's looking more and more like we are going to cut at least a quarter point. We're about 85% chance of that happening at this point in time. Might be pushing up against 90. That the Fed's going to act and cut at least a quarter point, but now we're leaning towards maybe 2 or 3 cuts, 75 basis points before the end of the year. Very, very possible. Right now the probability is not quite there, but we're leaning towards a couple of cuts going into the end of the year. All right, good news on Google. Google, that's the one highlight out of the Meg 7. And Google had a big run up because basically the government is saying we are not going to make you get rid of Chrome. I guess that was the big news. So Google doing very well out of the Meg 7. That's the main one. NVIDIA is still struggling. So solid earnings report. Had the NVIDIA trade on, and I actually took off. I took off half of my position on a little bit of a bounce back for a smidgen of a loss, but I only took off half. So I'm going to lose the maximum on the skip strike butterfly the open wing butterfly that we did on NVIDIA. I really liked that trade in NVIDIA. And bottom line is I didn't think that NVIDIA would blow the numbers away, but I didn't think it would sell off. A lot of times with NVIDIA, when they've had a strong move to the upside and a strong quarter, they blew away both on the top and bottom line, but the stock went down. And then it was acting like I was expecting it to, in that the market was rallying back because, once again, they had really good numbers. So the marketplace usually takes the event, sells it off a little bit, the stock starts rallying back, and before you know it, by the end of the week, the market is up on NVIDIA. That didn't happen, mainly because I think we ran into September and the PCE and in general market turmoil brought the stock down, and then selling begot selling, and before you know it, the market is now on NVIDIA. We're trading at 171.66, and no matter if you did the short term or the long term position, if you wrote it until now, you're obviously, all those options are worthless. Okay, so I'm going to lean bearish. Look at the SPX. I'm going to go a little bit wider today. we're doing 10-point wide spreads mainly because of cost, but we need to set it up. We need to set it up right away. With the VIX a little bit higher, they're a little bit less expensive. So just the normal, the 1-day volatility is up, but the VIX is also up. And also want to look at a VIX trade today too. So those are going to be the two trades. I'm going to stay away from individual stocks at this point in time, especially trying to get bullish on the market. I'm not going to try to fight the general direction of the marketplace. So right now we have the market right at 64.53. So we normally would go 10 points and then stop short on the 5 points. So we were 10 points wide on the long spread, 5 points wide on the short spread. And that layout was Education Monday for Memorial Day. I put a PowerPoint together that showed the setup of the daily butterflies. Ideally, we like to do them around 10:30. The show starts at 11, so we always a little bit late, which can cost us a few pennies when we're putting the trade on. So we're going to go 15 points wide today. We're going to buy the 64.70, and we're going to sell 2 of the 65s. So I'm just giving you a little bit of a change up, okay? Realize that this is a possible way to do this trade if you would like. So you go a little bit wider, you got a little bit wider area that the SPX can stay in. We're still going to open up a wing. The market is down. We're going to lean bearish. I'd rather lean bearish just in general anyways. And then we can either buy the 64.50 or the 64.45. So let's put the 64.50 in, and that's $8. And then we have 10 points, so we can make $2 if the market goes down. We're going to send that to the what if calculator. We got a wider range on the upside, and then we're going to look at if we go an extra 5 points here, though. So here's where we make the $2. 1.7. Oh, it didn't grab $8. It grabbed it. If we do it for $8, the profit on the downside would be $2 or 200 per 1x2x1 butterfly. We can go all the way up to 64.70 before we hit to the max loss. The break even would be 6,470 minus 8. So 6,462, which should be right about here. And that's where our break even is going to be. So we need the market to stay within here and anywhere down this way, and we would be profitable. If it just stays where it's at, this trade will end up being profitable. And we could get the maximum. The maximum that I can trade for would be the 15 points, which is the width from here to here, minus the $8 that we have on the trade. Now, like I said, by going wider, so instead of doing 2 and paying $3.50 for them or $7 and doing a 10-point wide long spread, we're going to go 15 points wide and pay $8. Now, if we shorten this up, we'd have to get this under 5, and I don't know if we want to do that, because I don't know if we can cut the cost. Yeah, we can't. We're not going to get low enough. But I've already talked about it, so let's look at it. 64.45. Let's move this to 64.45. But this won't be profitable if the market continues on down. It will be cheaper. 10.60. Yeah. I don't like it. I'm going to send it to the what if calculator, but I don't like it. How come that didn't click? It's not showing up there. Let me set it up again. 64.70 buy 55. Hit that twice. And then you go down 10 and you hit that once. Okay, now let's send that to the what if calculator. We're going to be down $5 or down one. I'm sorry, it's only going to trade for $5, which means it will be down $1.45. And it says 140 here. So I don't like that trade. Let's go back to the original. Let's go back and look at it. So if we are going to do a trade and we're going to set it up this way, we're 100% want to make sure that we're profitable if the market continues on down. So here we would not be profitable. Profit and loss graph is showing us that. If we did want, this one is not bad. I don't mind it because you do got some more room to the upside where you can be profitable on the trade. I don't mind that. Can we show the screen? There. Oh, wrong screen. All right, come back. Come back. All right, I got it. Interesting enough, that was in the Twitter feed. So I see it now. So this is the profit and loss graph for the 15-point wide trade. Send that one to ticket. There you go. 850. I need it to be 8. Don't want to do it for less than 8, but the market's moving in this direction. So it's increasing in price. But from the beginning, we were at 8. The trade's already up 50 cents if we executed right away. Let's adjust it. And let's go back to our 10-point wide one. So everybody can see it because they weren't looking at my screen earlier. Okay, clear. And I agree with you, Doug. It would be nice to be able to see the trade. There is no doubt. Thank you for letting us know that it's happening. Okay, so there's 10 points, and then we go 5. That's 350. It's just a more interesting way to do it. And you could do 2 of them. But gosh darn it, you just don't get as big of a run up if it goes this direction. If it starts to get bullish on us, our break-even point is much lower than if we do the 15-point wide one. So here's the 350 isn't it's $4 now. Everything it's moving hard to the downside right now. 64.48, so we're right there. I'll send it to the what if calculator. Okay, so let's just compare the two on this trade. We're doing the daily plays. Check the boxes so we can send it to the ticket if we want. And if we're looking at doing a 0 DT, just once a day trade, we put this on. This would be profitable if the underlying stock went this direction. 645. Yeah, it's really moving. It's hard to keep up. Okay, so our total risk here is $375 per 1x2x1 butterfly that we put on. We are 10 points wide. The maximum would be $1,000. So if we hit it up here, we landed right at our middle strike, the most that this thing could trade for is $1,000. If we do this trade and we set it up, which it's already quite profitable, actually, we'll send this one to the ticket. It's already up $1. We'd already think about getting out of the trade at this point if it happened that fast. But We were at $8 on the trade when we set it up, but let's just talk about the trade. In this scenario, you want the market to go right to the middle strike. The middle strike is $66,455. This would be trading for $15 at that point in time. You put it on for 8, you would be up 7 on the trade. But more importantly, the break even would be right here at if it was $8, it would be 6,462. That's where the break even would be. And then on the way down, the max profitable, if we did it for $8, would be $200. This is saying we're doing it for $8.30. Now the trade's at $9.05. Okay, now we go back to this butterfly. We're paying a lot less for it, and that needs to update 1 second. Should be about $3.50. That is not correct. And our break even then goes to $4. There you go. 6,460 minus $4 puts us right here at 6,456 is where it would be if we paid $4 for this trade. When we started, it was at $3.50. Maximum it could trade for would be $10. We would be up $6 on the trade. If it goes this direction, we paid right now it's saying $4. The maximum the value of the butterfly would be $5 at this point in time, and you would be up $1 on the trade. So what are the trade-offs? The trade-offs are the market can go up a little bit more when we go 15 points wide on the long spread, which means we have a higher break-even point if we're being bearish with the puts. We have possible to make more on the trade if we're correct. But obviously, on a one-off vacuum basis, if we're only going to do one contract, or one unit, one butterfly, we can lose more on the 15-point wide trade than we can on the 10-point wide long put butterfly trade. I don't know. Which ones do you guys like? What would you rather do? Would you rather... Let's play would you rather. Would you rather do the 10-point wide one, or would you rather do the 15-point wide one and pay more? I guess it really depends more so on if you are doing a one lot or if you are willing to do more than one butterfly when you put the trade on. That's the way I would look at that. Kurt wants to sit on his hands today. And wow. Market really moving that fast? Okay, we're down 12 there. $64.48. I don't know. To me, that means that I'm seeing the comments in there, Doug. You don't have a real idea. I mean, I think I want to lean bearish. I think I want to put this trade on. I want to keep it right here. And I think I want to do, I'm going to say it's at $4. I really liked it at $3.50 now. Leaning that direction. All right, well, let's make this one the paper trade. I don't mind putting this one on. I don't mind putting this one on at all. I think the market's going to end up down by the end of the day. There's just too much momentum to the downside. Okay, now let's go. Let's take a pick at the VIX. Let's take a peek at the VIX. The VIX right now, we have a trade around 1850. Let's look at the October contracts. So I guess I'll make this official. Let's go to the what if. Let's grab this. We're going to do this one right here, 10 points wide. We're going to stick with our normal and send it to the ticket. We're going to say $4 is our execution. When we started, it was $3.50, but we'll say $4. That's just how fast these things move. Okay, so $4 is our trade, and I'll look at the screen graph at 2-3 o'clock and see where we're at. All right, now let's look at the VIX. That'll be the official paper trade right there. I just want to entertain looking at the October expiration, and let's lean to the upside on this. Now, remember, the VIX isn't going to follow where the actual market is at. The October 22nd expiration is the green VIX. It's not the W's. It's not the weekly. Here's the September expiration. We did get long some of the 18 calls in September. That was part of the show. And now we're on the October 22nd expiration. And I want to start entertaining a trade in the October expiration, 49 days away. Right now, the market is at 19.5. It's right here, about 19.5. So we're going to buy that one and sell that one. That should be close to zero. All right. So that means that the futures contract on the VIX October expiration is trading at $19.15 real time, because we're basically at even. We're at zero on that trade. All right. Let's sell the 19s. All right, so here we go. This isn't going to be the official paper trade right now. Let's buy that 20. 49 cents. And we make 50 cents if it goes above 20. If it hangs out at 19 or anywhere above 17 and it closes close to that, if it would basically, it has to stay above 17 if we do this trade. So I'm going to send this to the what if calculator. Got 45 days. Premium's not going to come out of it. It's going to be an issue if we're going to go out that far in time. That's part of the reason why I don't want to make it an official trade at this point in time. What do we got going on here? Okay, ignore this. Look at this one at expiration. You're buying here right at 17. The market right now is at 1950. The market closes at 19, it'd be worth 2. If it continues on up and you did it for 40 cents, this would be 50. Yeah, there, and it's even showing you, keep your eyes right over here. And it's showing that. So it grabbed 50 cents as the price when we came in. And so you'd make 50 cents on the upside, anywhere from 17 up to 19. We're profitable somewhere within that range. And if we can stay above 17, we're good on this trade. It's going to be hard to get the maximum right here. If it goes out right at 19, it's going to be hard to get that maximum on that trade. Mainly because vols are going to be high. Let's see where the VVIX is at. VVIX. When we did our trade and we bought the 18 calls in September, the VVIX was below 100. It was trading right around 90. Now it's at 99.56. So our September options, if you did buy the 18 strike outright, that should be doing pretty well right now. But I don't mind I don't mind this trade. We're going to keep an eye on it. Give it a few more days, see if the market tames itself a little bit, and then I want to look to do this trade. So we're at 1950. So if we can get the futures contract to come down around 18 and a half, somewhere in this range, I could see setting up this trade. But that's the trade that I do want to do something that's going to expire on the Wednesday in October, the normal monthly expiration in October. Let's go back and look at where that 18 is trading with in September. Just buy that outright. 18 is at 118 at this point in time. There are 14 days remaining. Where is the market for September? And it's right around 18. So if we buy this and we sell that, we're going to get an error because we have too many legs. But the 18 in October, we buy this one. We sell that one. Net credit. So we're at about 1725. So we're below. The VIX right now is at 1648 and the futures at about 1725. And the VVIX is at 100. VIX has dropped off precipitously. Yeah, why are we seeing the VIX down? The VIX is down 67 cents. It's trading at 1650, and we got the market down a third of a percent. No, the market's not down there at this point in time. So this price isn't correct. There it is. I don't know why it's not updating in the watch list. We're up 24 today. Well, I don't know what to say. That number isn't right on. We're at 6,440, but we're up today. That's why the VIX is down. All right, well, let's go back and look at the what if calculator. I like this setup. I like this trade. The VIX being close to the 19 level. Yeah, I don't think I would want to switch it up and try to get bearish on it, but I'm kind of curious where the bearish trade is at. Let's look at the VIX bearish. See if we end up doing the butterfly. Let's go to October. And if we flip the script, we're at 19. I'm kind of curious how the put side would look. Buy. Sell 2 of the 18s. That's 2 points. And then buy one of these. That's 80 cents. So that would break even at 1920. 1920 is where that would break even at expiration. Send that to the what if calculator. It's not working out for us. All right. Well, bottom line is that the what if calculator isn't working. What if the what if calculator isn't working on the VIX? So here we go. 1822. If we go bearish on it, we're buying the 20, selling the 18. So this is 2 points wide. Then we go 1 point wide on the downside. So anywhere below 17, we're still going to make, well, here we would only make 20 cents on the trade because this is 2 points. This is 1 point. So we would make 20 cents on the trade if we finish below 17. Break even would be at 20 minus 80 cents or 1920. So we'd be right in here is where we would break even at. 18 would be a home run on the trade. We'd get $2 for the spread. And this is a cash settled index. And we'd paid a limit price of 80 cents for it. So we'd be up 120 if it could finish right there. And the put side, the skew is just different overall. I would like to be able to make 50 cents if it goes below 70. I still think I like the call side better. Yeah, we're up on the SPX trade is up $1. I'm getting mixed messages on the watch list and what I'm seeing in the chains. But it is up. So if we're looking at the trade, if we're up $1 on it, Anthony, I think I would I'd give it maybe till noon and get out. I think that's what I would do on the trade. Get up a little more than $1. Anthony, and we're looking at the 10 point. We're looking at the 10 point SPX or the 15 point wide SPX. $10 point. I got it. Okay. I see it. I see your comment. Yeah, a little disjointed. I apologize, but this number is screwing me up over here on this side on the SPX. That's down more now too. So it's 6,435 is where the market is at. 64.35, almost exactly right now. But this number is wrong. But if we go here, it's not wrong. Yeah. 60. Oh, no, it is showing it wrong. All right. I'm going to let it go. I can sit here try to figure it out on the show. All right. That's it. Let's keep the October trade in the back pocket. I don't think the time is right. We got the VIX coming down a little bit today. The VVIX is up around 100, which doesn't hurt on the butterfly setup. If we're going to do that on the VVIX, the fact that it's up at 100. So now on the low end, when we bought the long call, the fact that the VVIX was down around 90 was a benefit. The VVIX, the lowest that it really goes, let's look at a 1 year basis. The lowest point that it's been in a year was around 86. The other day we were at 90 and now we're at 99. So the highest, the peaks of the VVIX is right around 125. That's the if it ever gets to that level, usually the volatility ends up starting to come out quickly in the VVIX. And I would say on average, it's probably right around 104. But I guess I could I'd put in a 50-day moving average and look at where that's at. That would be, well, the VVIX is 30 days. Yeah, I guess you could do a 30-day moving average. Nothing wrong with that. But we're going to do one in October, going further out in time eventually. All right, everyone, that's it. We're there. Apologize for a little bit of the confusion within the platform, and we'll be back on. We'll be back. So I was going to say Monday we didn't have a show, so it's Wednesday. So we're going to be back on Friday at 11 a.m. Eastern time. We'll keep an eye on the VIX for October, see what happens continually in September with our 18 strike call in the VIX. And so far today, think about getting out of the trade. Noon, 1 o'clock. If we're up more than $1 on the trade, think about it and just close that position out. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.